Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks buzzing in trade. I am Devina Khanna. Let's welcome our guests on the show, Kalra of Target Investing and Umesh Mehta of Samco Securities. They both of them joining us on the show this afternoon. Page Industries, for one, has fallen to multi-year lows in terms of valuations after a poor quarterly performance. We discuss with our analyst whether there is more downside in store or no. Next on the list is InterGlobe Aviation. Numbers were decent as it earned more revenues per passenger and was also aided by lower fuel prices. We ask our analysts whether it is the only suitable bet left in the aviation space. Zee Entertainment's results were a minor blip due to an exceptional loss. However, the focus continues to remain on the deal. Can somebody look to invest in the stock until more clarity emerges? We discuss this with our analysts. And lastly, cement is a sector in focus. Most of the companies has delivered a strong quarter. We ask our analysts for one large cap or mid cap recommendation. All right, so let's start off with the first stock that we're going to be discussing this afternoon, and that is Page Industries. The consumption slowdown, obviously, the stock doesn't remain untouched by that, and you've seen that in terms of their quarterly performance as well, which was a disappointment. Though the management nonetheless guarded for a 20% growth, the stock has come up from very steep valuations. Remember, it was trading somewhere closer to 36,000 on. From there, it's sub 20,000. What does one do now that if they have the stock in their portfolio, or if they want to look at buying afresh at these lower levels, are they attractive enough? Samir, let's start off with you.
Yeah. So I think seeing the results and especially past 2 quarters, I think it's better to stay away right now because as you said, consumption is not being even left out here. And there's a lot of inventory pile up if you listen to the commentary from the management. And if they are going to correct it, they have to take production cuts. And if they take the production cuts, the operating leverage on the result sides will go out. And then I think next couple of quarters will be even worse of results. So I think it's better to stay away. I see another 15% kind of a downside because now your earnings change. Now earlier you were having 15 to 20% kind of a CAGR for at least past 5 years.
But they've kept stuck to that.
They've kept stuck to that, but if you see the results don't show the story. The only point is if you have a 10-15% kind of a degrowth, now all of a sudden in next quarter you cannot go on the 20%. It's mathematically and operationally, I think, very difficult to do that. It might take another couple of quarters for because consumer companies are pushing that expectation to second half of this financial year. So I think let's see first half of this year, and then you can take a pick whether you want to invest or not.
All right. Umesh, what about somebody who already has the stock? And do you agree with Samir?
So I agree, yes, that one has to keep away from the stock. And if someone has, it's better to get out. So this dogmatic statement comes from the fact that we forget laws of economics, As in an industry, one stock cannot outperform forever. So Page was that kind of industry where in the entire industry, textile industry had a normal growth and had normal valuation, but Page was an exception. So if you see that 10-year compounded growth was 30%, 5-year has come down to 25%, 3-year has come down to below 21%. So there is a continuous degrowth, not in fact degrowth, but the velocity at which the company was growing is slowly decelerating. So now last year what happened is in the bogey of consumption, Page again got a re-rated P multiple, they got an expansion. But hidden was the ultimate tectonic shift that was happening in terms of growth was getting slowed. And that was not, people could not see that because there was a bogey that consumption stocks are going to do great. And now suddenly sky has fallen apart and people think that, oh my God, Page is not a great stock. But currently, given the valuation at 55 times and stock growing at around normal 10%, does not warrant such high valuation. So now the time for PD rating will start, and that will take the stock far below what we see this current level. Maybe not immediately, but yes, over a period of 1 to 2 years, I think the stock will underperform and portfolio value will be negative. So it is better to get out. So sometimes these learnings we can draw and decide other sectors wherein similar things are happening. So you've seen even Eicher Motor. Eicher Motor also growth came down from 60, 40, now it's 20. So this is how, when growth investing, people want to make money, great. But when they are doing growth investing, they also have to see when the growth decelerates, it's time to get out and not to stay by it.
All right, but Samir, do you think there were telltale signs from Page? And like Umesh pointed out, that under the garb of the consumption growth story, Page was getting these extremely stretched multiples. And now that the consumption story is disintegrating piece by piece, the worst hit are some of these names that actually, rose significantly, riding high on this story.
So if you see these particular stocks, whether you talk about Eicher, Page, there were a lot of institutional investors who got in early, and if you see the results kept on supporting the valuations and justifying it somewhere or the other, and these institutions kept hold and kept it tight with themselves, and certain institutions, for them, certain portfolios, these companies became very large part of the portfolio as a percentage. Now when the results don't support the valuations, they have to start selling it off. Now these are very illiquid names, so even a 10% or a 5% kind of move is justified when you start to sell it off. So I think that impact or that technicality also impacts these stocks, whether it's Eicher, Page, or all these illiquid institutional high holding stocks. So I think that's why I'm saying, so another 2 quarters, if the results are still downstream, I think this will accelerate. And if there is no sign of any kind of reversal in consumption, so now they enter the zone of on sell any kind of a bump. So any kind of 5%, 6% kind of up moves, you'll see people selling out rather than buying in.
Into it.
So I think that's why the story goes off for at least a 6 to 9 months.
All right. That's a quick word coming in from both Samir and Umesh on Page Industries. The next one is Indigo. This industry as a whole is also plagued by issues of its own, but Indigo seems to be standing tall within that chaos. It reported its 4th quarter numbers, and not just operationally, but you did see the yields also moving up about 12.5%. The stock, though, in intraday moves is up about 1% or so. But remember, you have been seeing a lot of brokerage upgrades coming out on this counter. Umesh, I'll start off with you. What's your sense about Indigo, and how do you pit it against SpiceJet? I wouldn't say Jet Airways right now, because that has issues of its own.
Correct. So Indigo, investor will approach differently and a trader will approach differently at this point in time. So it's a foregone conclusion that aviation is a cyclical industry, and in cyclical industry, how you make money is you buy when things are bad and when companies are making losses or the industry is undergoing a problem. So currently in this industry was into problem, but Indigo and SpiceJet were the star performer because they were able to capture the market share. And since last 1.5 years, Indigo was in an expansion spree and they were able to expand their fleet. And in last 3 months, the quarterly result that we have seen, so they had a fantastic numbers because they were able to capture the incremental growth at nominal cost and 12% yield increase that you have seen. I think that's a result why that is a reason why we have seen fantastic numbers this quarter. But cyclical stocks top out when numbers are great, when things are going great. So from an investor's point of view, now the differentiating factor starts. So if one wants to invest for 3-5 years, I think then Indigo is really not the space, because given that it's cyclical, given that there are a lot of risks, what if Jet really comes and it is being bought after a proper haircut? Jet will
that
again...
story is independent of what the growth of Indigo is, right?
Correct. So growth of Indigo can be impaired. So there are certain risks that investor has to take into account before investing. So if really Jet comes in, maybe whenever it comes in, then predatory pricing will start, then again the reversal will happen, the yield increase that they had might dissipate. So from investing point of view, I think this stock has got a lot of risk. But from trading point of view, I think still there is momentum. 1 year down the line, if forward P is around 22, given that 73 EPS, 70 odd EPS company can do, still I think from trading point of view, yes, momentum is there. But a trader also knows that he has to exit. He can't hold on for long. So trading point of view, yes, I think still money can be made. But investors, I think this is not a this is not a good time, because margin of safety is very less. There are risk attendant to it, and cyclically when things are really best, those are times actually not to invest but to disinvest. So this is what our or take profits, correct.
All right. Samir, what's your sense on Indigo?
So I think I was positively surprised on the results. Two factors. One is their non-metro yield went up. So that was kind of a benefit where EBIT margins beated the estimates. Second, the international operations now account for 14% kind of a total revenue. So that again is a high margin business.
And that could probably increase.
Yeah. So if you see their commentary, the additional aircrafts they are adding, so 50% will go for the international expansion. So that will increase. So I think their target is around 20-25% for next FY20. So that will really benefit the margins as well. Because over there, if you see, the prices are higher, the ask is higher for them, and the costs are still low. Except the fuel costs, other costs are still fixed for them. So I think they will make good amount of money, but incrementally, would I put my money out here? I would stay away. I would hold on to the positions I have. If you see SpiceJet, I think over there the capacity expansion is, right now they are at 100 aircrafts. Now they are adding 40 more during this year. So that's a 40% on the capacity of the aircrafts. They have Udan doing well.
Yeah.
They have international coming up well. So I think now the international forum for both these companies will open up much more better. They have started doing business class on the aircrafts taken by Jet. So I think there's a little more upside left in SpiceJet as compared to Indigo right now. Because even the market shares, if you see domestically, Indigo still has a very difficult to go from 50 to 55.
But I think on a 6-month basis, SpiceJet has really outtaken InterGlobe.
Yeah, so that's what I'm saying, because a lot of benefit which was unexpected out of jet catastrophe came to SpiceJet. And
100 in their fleet, 100 aircraft in their fleet.
100 in the fleet, 185 slots, and Indigo was 180. So that I think really gives a bump up to Spice, and I think there's a lot of catch-up rally over there.
All right, that is the stock that we're talking about, InterGlobe Aviation. Remember, the stock in today's session already the stock has run up quite significantly in the last 3 months and 6 months already. So you're not seeing too much of a reaction in terms of the overall price point right now. It's at 1678, but nonetheless, 3-month, 6-month performance has been spectacular for both InterGlobe as well as Spice, and that deviation from Jet has just widened in terms of the pricing performance. The next stock that we're going to be talking about is Z Entertainment. Obviously, the numbers do take center stage now, but the bigger focal point is going to be the management commentary with regards to when is the actual stake sale going to culminate. And they highlighted that binding bids will be received by the month of July. So that's the time frame that they've given. The stock is up about 3.5%. Remember, in terms of ad revenue growth, they've guided for low teen growth for the industry, though they said that Z will beat it in terms of FY20 subscription focus. That too, there's a growth in just the low teens that they highlighted, and that will not change. Probably they'll take a real look at it post Q1. Samir,
Yep.
Z?
So I think if you see the numbers, 3 things very clearly came out. That the new tariff regime has an impact. And because this quarter only had 1.5 months of this, and there was transitioning also happening. So I think the impact on quarter itself was there on the subscription and the advertising.
Yeah.
So that I think I'm very skeptical on.
And they've said low
3
teens.
months.
They've anyways
But
guided
I
for low
think
teens.
there will be a bigger impact, because if you see their standalone numbers also, viewership numbers, Pre the new tariff, they were around 7.5 lakhs. Now they're around 5,80,000. So that's a big downturn on a standalone basis. On the subscription level, again the hit will come, and quarter on quarter, if you manage, there'll be, I think, a bigger hit coming up in the results in June. Second, if you see the balance sheet, the cash flow drain is just increasing. Right now,
and they're paying a lot for content for Z5 as
yeah,
well.
and the only point is they're not even able to increase the prices for the Z5. If you have that kind of a customer base, and if you can increase even a 10% or a 5% prices, I think the stickiness of those customers is not there. The conversion from a free to paid customers is not there. That's why they are not able to manage the conversion or increase the prices. Because I think now you're reaching that point, either you increase the prices, better your cash flow, because the cash burn on the content is too high. And the working capital is stretching your cash books. Because earlier Z used to get this valuation of being a debt-free company and a cash-rich company, which I think takes a hit now. And I think as per the stake sale, I think it's still too early. Let's see July how it works out. If they get a binding bid, how much is the value and where the stock is during that time.
Okay. Umesh, the point being is up until now, nobody really questioned the growth of Z. While the issues with regards to what the promoter is trying to do with the company, has some stake in the company, that was something that was kept aside from the operational part of Z, and no one questioned the business growth outlook out there. But do you think that is becoming circumspect now?
So now, if one has to invest in Z, one more additional factor of promoter stake sale has entered into his decision-making realm. So now, if the bargaining power of promoter, he is in the back foot, because the looming debt payments that he have in his other private companies will now they will not be able to squeeze premium from Z from the buyers. So I think the higher open offer price, earlier if they were able to sell, would be around 500 rupees plus Z shares. But now, given the time delay and given that they have banks' pressure to pay off the debts, so the premium squeezing capacity of the promoters has really reduced. And the 26-week average price has also come down to around 420. So now, from an investor's point of view, there is no big hurry that I need to invest right now, or the valuations are really so attractive that this is in any case going to be a bottom price. So no, all those things are not there. Z is reasonably valued, plus the inventory build-up that they have and how they are going to resolve this issue, given the new management will come in and how they do it. So there are so many ifs and buts currently that are there in Z. Therefore, it is better to avoid right now. There is no tearing hurry. We have seen Fortis also, Fortis Healthcare, although prices were attractive, but still the stock is going nowhere. So when these situations are there, it is better to wait and watch and really not get carried away and just blindly go buy and then let's have. So it is better who the management is, and then a lot of clarity will come, because prices will really is not going anywhere.
Nonetheless, from its recent low, I think it made a recent low of about 308. From there, the stock price has really recovered pre-earnings, and post that as well, with some clarity on the timeline of the binding agreements, which is July. It seems like the market has digested that well, but the last 6 months still have a negative return for Z, about 22% under for Z at 373 now. The other one now that we're going to be focusing on is going to be the cement industry. We've been looking at how things have been picking up. Q4 particularly has been good for most of the cement majors within the large cap space as well as the mid cap space that have reported their numbers. Realizations have picked up. You've seen pricing power coming back. In fact, it's been the 5th straight month that you've seen pricing hikes being taken by cement majors across India. Now, whether or not that happens to stick or they roll it back is another question. But let's get in our experts to talk a little bit more about what they like within this space. So Sameer, let's start off with you.
So I like Shree Cement in this space, though I like Ultratech as a large cap, but Shree Cement is my focus right now because I think the cash flow over there is much better as compared to other mid cap companies. Their volume growth has been fantastic. They are showing around 25-30% kind of a volume growth in last year, and I think now they are focusing on pricing for FY20. And this pricing focus will change the margin profiling as well, which was getting hampered during the volume output. So I think now they have done their capex, the pricing power will come back to them because they are the leaders in north and almost northeast kind of areas. So I think over there there's a lot of benefits as compared to other cement companies, and there's a big leg up pending in FY20. So I think Shree Cement is a better place to be.
Okay. Do you think that the play is going to be more region-wise? It'll continue to remain region-wise?
So I think the play will be on two ends. One is the national player being dominated by Ultratech because of the JP synergies they are getting from the capacity and the spread they have got regionally. So that will help out. Being a national supplier, they'll get these national projects which are able to throughput much more easier because they prefer one supplier throughout the belt. Secondly will be the regional state level projects and the state driven projects. They are being helped by the regional players because over there the pricing comes out better and the bidding is much more between the regional players rather than the national player coming into the picture. So I think over there north place, I think Shree Cement is a player to be with, and their focus, if you see last year they had only taken a 2% hike, whereas the whole system and the whole industry has taken a 5% plus kind of a hike. So I think now if they come back to the focus of pricing and their volume growth sustains at 10%, so I think now Shree Cement will give that focus and they'll win a lot of orders at the level of north.
Anyways, with the big push post-elections for infrastructure, this is obviously a big beneficiary sector. Umesh, what would you do with cement, and would you go with a smaller mid-cap name within the pocket, or would you like a bigger pan-India player?
So as you rightly pointed out, the biggest push to the cement industry came from government spend. Because government was in election mode and previous 9 months government really pushed hard all those infrastructure projects, and therefore cement companies had a fantastic year and quarter, and given the great valuation and given that the government has come in, people are betting that cement will keep on that growth. But that may not happen because once now government comes into power, they are not really going to push that hard investment in infra because they have got larger fiscal deficits to maintain and other investment priorities that the government has, and private sector investment is really not that happening because private sector money is building, they are building technological platform, and the real capex that is happening at the ground level will not come immediately from the private sector. So there will be a lull in the cement sector, and we don't see that amount of growth in next 3-4 quarters. So next year will
quite
be
a contrarian actually.
No, so it's not a matter of contrarian. Cyclicals always, you see, we have seen 20 years of cement cycle. Cyclicals always make top when numbers are great, when margins have expanded, and when people think, oh my god, the growth will be there. But the nature of cyclical is such, when things are really looking so good and great and people want to invest, that's the time exactly when they really need to get out and wait for slow down and wait for cycles to come down, wait for margins to come under pressure, let the operating leverage work negatively in those companies. Those are the times one has to invest. So given that currently the mood is good and sentiment is bullish, we think in order to play cement, the only way to make money is catch-up rally. So Ultratech and other large caps are trading at around 50-60 PE multiple. ACC is trading at around 20 PE multiple with the same level of efficiency. We think catch-up rallies are a good way of making money in cyclicals. So I think ACC would be a good bet if investors want to build that portfolio. But that's all from a trading perspective. From investing perspective, as Samir had rightly pointed out, I think Shree Cement is a great stock. It keeps on building the capacities, but currently we don't really need increase in capacity because industry is available at 76 or 78%. They are running at that level of capacity. So capacity expansion is not a key play, but valuation catch-up will. So I think ACC would be a better because they really don't have that capacity plans under play. So that will really help investors benefit from that up rally that we will witness.
All right, so there are two stock ideas there, ACC on a catch-up play by Umesh and Shree Cement from the mid-cap cement pocket as a recommendation from Samir. Well, with that, it's a wrap on Hot Money this afternoon. Ask BQ is up next. Stay tuned to Bloomberg Quint, and thank you to both our guests for joining in this afternoon.